Buenos días a todos. Buenos días, bienvenidos a la presentación de este Oil Report. Esperemos que todos estéis bien. Como conocéis, vamos a hacer esta presentación en inglés y por tanto I'm going to switch to English to introduce our guest, in this case Mrs. Toril Bosoni. Maybe you knew him because he came here last I think in 2008 to present with Neil Atkinson this report. Toril, we like to give thanks to her because this is after 1 week or something or 2 weeks. She has presented this report internationally all around the world, and we are now, we have commented, we are now in an exciting time for the oil report. This report is a flagship I think the flagship is the monthly report about the oil. No, she's responsible for this, and we are going to give this presentation, and I'm going to do this here. Toril Bosoni, she was appointed like a senior analyst, like responsible for the new head of the oil industry and market division in the agency, I think at the beginning of the year. But she has been working in this area for many years. She has developed this oil monthly review report, very well known in all the community of international oil affairs. And I think in this case you will have the presentation will make her available, and you will have you can download free download the report in this case, and before you will need to pay, and now you can download free. I said before, it was a very big, interesting momentum, interesting and exciting for the oil sector, with this geopolitics becoming a bigger factor in the markets, with these huge uncertainties about the question of demand and the big increase in renewables, in clean energy, and with important changes in the geostrategic of OPEC Plus, etc., etc. And now with the Suez Canal affair in the last week or last 2 weeks. Well, it's a pleasure of having here with us Toril. I thank her for coming after this, putting out this report in the 17th of this last month. This is a pleasure. I will give to her the floor, and thank you again. The floor is yours, Toril. You will try with your presentation. Go ahead, please.
Thank you very much. It's a great pleasure to be back at the Spanish Energy Club. It is unfortunate that we cannot meet in person, but maybe such is the state. In France, we're back in lockdowns now, so we're all working from home. But I'm going to share my screen now, my presentation. So share. Can you see the presentation? Here.
Sorry, we can see it.
You can see it very well.
Yeah.
So we released the report 2 weeks ago, as you know, and what we were looking at to see how the oil market will develop after COVID. So of course, 2020 was an exceptional year. Oil demand collapsed. As you can see here on this graph, we're showing how our demand projections evolved compared to the forecast before the pandemic. And as you can see, we had an unprecedented collapse in 2020, nearly 10%, but we're expecting oil demand to recover. We're already seeing signs of the recovery now towards the end of 2020 and early 2021. And we're seeing that oil demand is growing again all the way every year to 2026. In the absence of stronger policy action. So here we're seeing oil demand in 2026 is going to be above 4.5 million barrels a day, above the pre-pandemic level, with oil demand growing every year. So what we're seeing from the 2020 low, oil demand will grow by 13 million barrels a day to 2026. From the top, on the top part of the graph, you can see that most of the growth is coming from Asia. But OECD is also growing from the low of 2020 and the rest of the world. And what I see here, compared to the pre-pandemic levels, this is where you're seeing that Asian economies is accounting for nearly 80% of growth, and demand in the OECD countries will never return to the 2019 levels. In terms of the products that are growing in demand forecast, we can see, of course, compared to 2020, we're expecting a strong recovery across all the products. Gas oil and motor gasoline obviously took a big decline last year due to the restrictions on mobility, lockdowns imposed in many countries. Jet kerosene saw the biggest fall, but we're expecting this to recover over the coming years. But if we're comparing the demand growth compared to the pre-pandemic levels, we're seeing here on the right-hand graph in blue that most of the growth are coming from the petrochemical sector, light products such as LPG, ethane, and naphtha. In terms of comparison to the pre-pandemic levels, we're not expecting gasoline to return to 2019 levels. Gasoline, jet kerosene take the longest to recover of the other products, and we're not expecting to be back to the pre-pandemic levels until 2024. In terms of gasoline, it's of course one of the major factors playing into the forecast is increased use of electric vehicles. We saw in 2020, even despite the crisis, the economic crisis that we saw, people being restricted at home, we saw very strong electric vehicle sales in many countries, China in particular, also Europe, and we're seeing increasing push to increase the electric vehicle fleets in the United States. Of course, the US President Biden's new stimulus packages is putting emphasis on this, increasing the role of of electric vehicles. But it's also efficiency progress in terms of the engines that we're seeing that are playing in. So these are the reasons why we do not expect gasoline demand to continue to grow. Of course, the efficiency factors and electric vehicles are stronger in most of the developed world. We're still seeing growth for mobility in countries such as China and other developing economies, especially in Asia, that will continue to grow, but it will not be enough to offset the declines that we're expecting elsewhere. So, but what we wanted to look at, of course, you all know that 2020 and 2021, we've seen a real shift in terms of government policies and ambitions to reduce carbon emissions, climate change. So we wanted to see how these targets and how the policies would affect the demand going forward. Of course, many countries have set net zero emission targets for 2050, even earlier in a lot of European countries, but we wanted to see, because a lot of these targets have not yet been translated into policy, concrete policies to reduce demand. So in our base case, it's why we're expecting oil demand to continue to grow. But we wanted to see what it would take to get oil demand to fall, what it would take to make 2019 the peak in oil demand. So what we're seeing, if you increase the efficiency in the vehicle fleets, you can easily reduce, even just by 1 year, oil demand in the transport sector can decrease by 1 million barrels a day. We looked at the impact of behaviors. Of course, we all made significant changes to the way we live, the way we work, the way we travel in 2020. And we were looking, in our forecast, we're expecting some of these changes to be long lasting. We think that teleworking, working from home will be more widespread, although we obviously not at the level that we're seeing currently or in 2020. And business travel will also, we think, will be reduced compared to what we saw pre-pandemic, as a lot of these meetings and business trips now with the new technology, with the new skills that we have developed over the past years, will likely be reduced. But we could very easily, if we increased the working from home from 1 day to say 2 days, we could very easily make a bigger reduction in oil demand. And there's a lot of uncertainty about this, changes in behaviors and how they will unfold once we get back to less restrictions in the different countries. We also looked at increased electric vehicles. In our base case, we're expecting to have 60 million electric vehicles on the road in 2026. If we increase this by 50%, we could reduce oil demand. But as you see, in terms of overall impact on demand, the impact is not all that big. So it would take stronger policy to see oil demand peak. Here we looked at policies such as reducing oil use for power generation, reducing subsidies, but it's going to be very ambitious to see all of these policies being put in place in the near term, because it has to be done relatively quickly. But if they all were put together, we could reduce oil demand by 5.6 million barrels a day, so that we're really seeing 2019 being the peak for oil demand. So, but with this uncertainty about how the economies will recover post-pandemic and how behavioral changes will affect oil demand going forward, and of course also the collapse in demand, collapse in oil prices in 2020, we saw that the oil industry making very significant changes to their plans for the future. In 2020, upstream investment fell by 30% compared to 2019. Final spending on upstream projects for oil and gas was a third less than the companies had set out for at the start of the year. And for 2021, based on company plans that have already been announced, we're seeing a very small increase in spending on upstream projects for 2021. Most of the major oil companies have also reduced their longer term spending for the next 5 years by about 15–20% compared to what they were planning earlier. So it's clear that the concern about how energy transitions and the future of oil demand will unfold is having an impact on upstream spending going forward. So as a result of this cut in investment that we saw in 2020, and also because of some delays to projects due directly to COVID or due to the lower prices or disruptions to supply chains, we're seeing that the capacity growth in oil supply really rising by just 5 million barrels a day. If you remember what I said just a few moments ago, oil demand has to grow by 13 million barrels a day. So we have 13 million barrels a day of oil demand growth from 2020 to 2026, but oil production capacity is rising only by 5 million barrels a day. But as you know, 2020, we saw a lot of oil production being shut in, mostly in the Middle East, and other countries taking part of the OPEC plus supply cuts. So there is ample spare capacity in the OPEC plus countries to meet this oil demand for at least in the near term as we see it. Here, to meet the demand increase, global oil supply has to rise by 10 million barrels a day. And we're seeing that the key Middle Eastern producers accounting for nearly half the increase. The outlook for US oil supply has shifted lower since 2020. The US independent producers cut spending much more heavily than companies that are operating elsewhere in the world. As you can see here in a second, our forecast is for relatively modest growth in the next years in the United States. One of the reasons for this is a new strategy to upstream investment for most of the producers, where the companies are prioritizing paying back debt to their and rewarding shareholders with increased dividends and so forth, and a much more modest growth profile projected forwards. We also seen a lot of mergers, very large mergers in the shale industry in the United States, and we think that this would also result in slightly lower growth than what we've seen in the past. Of course, oil prices have increased quite sharply over the last months. Since November. Now we're currently at $60. So it's not impossible that US companies revise their investment strategy. At current prices, we think that that the companies can honor their pledges to pay down debt, to reward investors, and still grow their productions. But we do not think that the very high growth levels that we saw in the past will be repeated. But of course, the US shale industry has surprised us in the past, and the potential is definitely there for US production to rise more sharply in coming years, should the oil prices stay at the current levels. So how do we see all this playing out in terms of oil demand and supply going forward? As I said, we're currently sitting on a lot of spare capacity due to the production curtailments in OPEC plus countries. And we're thinking, and so as oil demand recovers, this spare capacity cushion would slowly erode. But even by 2026, we're seeing that there's still some spare capacity left in the market. Here, we're adding Iran on top of it. If sanctions on Iran were to be lifted, there's of course a strong potential for Iranian production to increase on top of the other increases that we saw. And as we've seen in the last few months, we're already seeing evidence of higher Iranian production flowing primarily into China. And now with negotiations starting up between the US and Iran about the nuclear agreement, there is a possibility that the sanctions will be lifted that will enable Iranian supplies to come back to market. But this is one of the wild cards that we're seeing as well. Huge difference with oil production potentially being able to rise from about 2 million barrels a day today to 3.8, where we estimate that their production capacity currently is. So in terms of refining, I want to talk about refining at the end. Of course, you know that the refinery industry was especially impacted by the crisis in 2020. Refining activity fell by about 10% year on year to the lowest since 2010. And we saw that margins fell very sharply. Even as crude prices fell, margins fell even more sharply to the lowest in 16 years. So looking forward from that starting point, looking forward to the next 5-6 years to 2026, we're seeing that there's still a lot of refinery capacity expected to come online in the coming years. Oil demand level has shifted lower compared to our previous expectations. But of course, this refinery capacity builds and expansions were in play long before the COVID crisis. So there's about 8.5 million barrels a day of new capacity set to come online from 2020 to 2026. In 2020 and early 2021, we saw that a lot of announcement of capacity shutdowns already coming in due to the lower demand outlook. But we're still seeing net additions about 5 million barrels a day from now to 2026. Most of these additions are coming from east of Suez. That means Asia, China primarily, Asia and the Middle East, where there are some large refineries coming online in the coming years. So looking at the net capacity additions of 5 million barrels a day, it's relatively similar to the net additions that we had in the previous 5-year period. But if we look at that capacity additions compared to demand growth, here in light blue, you can see that's for total oil demand of 4 million barrels a day. But if we look at the demand that is coming from refined products, with that means that the products are coming that are made by refineries, so excluding biofuels, excluding gas liquids that go LPG and ethane that goes from gas processing and directly to the petrochemical sector, we're seeing that the levels is roughly half of the previous period. So the result of that is that we're expecting the COVID-19 to speed up a third round of global refinery closures. We were already expecting there to be surplus capacity in the refinery industry for the next 5 years. But because of the COVID and the lower outlook for demand, we're expecting more closures to be announced in the coming years. So here we just looked at the first wave of refinery capacity closures in the early 80s, 12 million barrels a day of capacity was closed to a large extent in Europe. Second period from after the financial crisis, we shut about 7 million barrels a day of capacity. And as we see it today, we think that in this third round, we will require 6 million barrels a day of capacity to close. 3.5 million barrels a day have been announced. Some of it is already shutting, but more is to come in 2021. But there will be more refineries that would need to close if we're going to get the refinery capacity utilization rates back to sort of the 80% level that is considered necessary to ensure healthy refinery margins. Of course, this is nothing new. We're expecting the east of Suez, Asia and the Middle East to drive the increase in refinery activity in the coming years, along with increased demand for products in that part of the world. And in the Atlantic basin that covers Europe, the Americas and western part of Africa, we're not expecting refinery activity to come back to the levels that we saw pre-crisis. And here it's a little bit similar to the chart I was showing just a second ago. The reason is, of course, that demand growth is coming almost exclusively from the east of Suez. And in the Atlantic basin, we're expecting oil demand to decline. If we exclude the products that are coming, such as ethane and LPG, other oil products demand is set to decline in the Atlantic basins, and we're having some increased capacity in the region from Africa, some smaller additions in Mexico and so forth. But overall, all of the growth in demand and in capacity is coming from the east of Suez region. But just to make a point, the capacity increases in the east of Suez is larger than the increase in demand. So competition will also be felt by those refiners in that part of the world. We saw the refinery shutdowns that have been announced so far are very widespread. It's not just Europe, it's in the Americas, it's in Asia, Australia, and so forth. So the pressure on refineries will be felt across the globe in the coming years, we think. We think refinery margins will struggle. Here we're looking at the growth in oil demand, excluding the non-oil components. So if we look at premium refined fuels, that's gasoline, jet kerosene, and diesel, excluding ethanol and biodiesel components and so forth, we're seeing that this part of the refinery output is actually set to decline. HSFO, high sulfur fuel oil, is declining because of new sulfur regulation in the marine sector. And ethane, LPG, and naphtha is really the only growing part of the barrel, with the exception of very low sulfur fuel oil that we're expecting to continue to grow in coming years as the marine sector switches over to lower sulfur fuel. And this does provide an opportunity for refiners to capture some of that margin. In terms of regions, China is leading the growth in activity. A lot of new capacities being built there, both in terms of traditional refineries, but also in refineries with very high petrochemical integration. We're seeing a lot of increases in India as well and in other Asia, whereas the OECD Asia that captures Japan, Korea, Australia, and New Zealand are seeing lower refinery capacity in the coming year. So we can just see that in terms of refinery throughput, China really drives the growth, as it has done for several years already. In terms of Europe, we're seeing that European refining has fallen since the peak rates that we saw in the early 2000s, but the lower prices since 2014 sort of helped stabilize some of the activity levels. Demand grew over the same period. Refineries didn't increase runs, but instead increased imports. But we're seeing, as we're expecting oil demand in Europe to, if not to be at the lower levels, we're expecting the refinery throughput numbers also to decline from the 2019 levels, sort of in line, about 1 million barrels a day lower than 2019, largely in line with the expectations for oil demand in the regions as countries step up efforts to meet new climate targets and improve efficiencies across the products. Middle East, as I mentioned, we are in the Middle East, we're building a lot of new capacity. Middle Eastern oil demand is not expected to grow as strongly. So this will result in higher net product exports from the Middle East. Actually, Middle East becomes the largest refined product exporter in terms of regions, overtaking Russia, that is
expected to hold relatively steady. And also we're seeing a strong growth in NGLs exports, not a strong growth, but as the growth in US natural gas liquids slows, they're also becoming the largest supplier of gas liquids to international markets. In terms of crude oil imports, the very strong growth in demand and refinery throughput expectation obviously means that the Asian markets will need to increase their crude oil imports. Even as Middle East crude exports increase over the period, it will not be enough to meet the growing demand in the region. So we're expecting there to be more long-haul trade of crude oil. Crude oil will have to go from the Atlantic Basin, that is the Americas, both North America and Latin America, where there's some, but also from the North Sea, where we're seeing some increases in production from countries such as Brazil, Guyana, Canada recovering, some growth from the US, but also Norway that has some projects still ramping up. So a lot of the trade that we will have longer trade routes, longer shipping times, and we're seeing that the net oil import dependence for Asia will increase to 82% in 2026 from 70% in 2019. So this is obviously having implications for security of supply. We just heard about the Suez Canal last week, 10 days ago, and we're seeing as more of the crude oil is traveling in the directions from Europe and the Americas to Asia and the Middle East. Previously, a lot of the flows in the Suez Canal was to bring in crude oil and products from the Middle East into Europe and the US. Now, actually, most of the trade is going in the opposite directions. So this is something that obviously would have implications going forward.
In terms of net refined product imports, we're seeing relatively stable situation in Latin America. Africa, slightly reduced requirement for product imports as a very large refinery comes online in Nigeria in the coming years. Europe, slightly higher import requirements due to the slowdown on the refinery side. But we're seeing that the Asia 4 here, that is Australia, Indonesia, New Zealand, and Singapore, is going to become the largest product importer hub in the world, importing about 2.4 million barrels a day. We've seen a lot of capacity closures in recent year and announcements for further closures, and also relatively strong growth in demand in Indonesia, at least, less so in the more mature economies of Australia, New Zealand, and Singapore. So there will be a lot more trade in products as well, but more concentrated in this area. So with all of this, for the refinery industry is facing a lot of challenges going forward. Of course, the energy transition is an additional challenge to the refiners. So not only do the refinery industry have to adapt to the lower outlook for oil demand and the shifting patterns in terms of the fuels and the regions that will drive the growth, but obviously the refinery industry is very energy intensive, and they have the challenge of reducing the CO2 emissions in their production activities. So decarbonizing the refining industry will bring challenges to the refining industry, but it also provides some opportunities. As you know, we have looked at the sector in terms of opportunities for them to be part of the energy transition going forward. And because of the high skill set, the highly skilled workers, the technologies, the engineers, the industrial sector can really play a part in developing some of the technology and some of the solutions that we will need to reach the net zero targets. These includes renewable electricity, green hydrogen, green and blue hydrogen, carbon capture and storage, advanced biofuels, and chemical recycling. So there is still a lot of opportunities, and we're seeing that a lot of projects have already been announced in this here in France, in Europe, but also elsewhere. So we're seeing that these are moving ahead. So with that, I'd like to stop my presentation for now. As Mr. Gutierrez said at the start, you can find the full report free of charge online on our website. So I hope that you go and read. There's a lot more information there about how companies are dealing with the energy transitions and of specific regions and products. But in the meantime, I'm happy to take any questions that you might have.
Okay, thank you very much, Toril. An outstanding presentation. As always, this is a pleasure having you here once again. Very important, the overall about the refineries this year. No, this year I think is more is bigger. No, the extension to this refinery sector, which has been affected by this downfall of demand. Well, I'm going to introduce Ana Padilla. She's receiving all the questions they are sending us. The first of all I have seen it was about the Suez Canal blockade. You did so you said something before, no? But this is a cultural issue, very important, no? Okay, maybe Ana could translate you all the question we are receiving about this. Thank you again, Ana. Or you can comment about the Suez Canal before, if you would like something more, because I saw one or two questions about this. No? How can they affect the production? How they affected Europe, etc. No?
Yes. No, on the Suez Canal, so we had a good look at this. We actually produced a commentary that we published on our website it came out last Friday, Saturday. And from that report, in that commentary, we highlighted some of the issues that are very much related to the trends that we're seeing in the oil 2021 report. But, you know, the point that the Suez Canal, the conception from the public is that the Suez Canal is bringing goods from the Middle East and oil from the Middle East into Europe, into the Western world. It's not really the same anymore. There's more oil flowing in the other directions. We think that one of the reasons that the Suez blockade didn't increase crude prices so much, obviously, is related to the situation that the oil market is in today. Oil demand is still recovering, is still way below pre-pandemic levels. Refineries are still running at lower rates, especially in Europe, you know, but all across the globe. There's still a lot of capacity. We still have oil inventories. There's been a lot of talk about, of course, the oil market is rebalancing, and oil inventories that built up in 2020 as the oil demand collapsed have gradually been decreasing after OPEC plus reduced crude oil production. But we were still above the levels that we were a year ago. So there's still, I think, for refineries in Europe, and that would have been most directly impacted by the blockade in the short term, there were still inventories to continue operations. The Suez blockade didn't result in any loss of production. It just resulted in a delay of that, some of that oil getting to market. But because we had the inventories at refineries in countries, it didn't result in the supply disruptions as such. In terms of products, obviously for the European refiners that export fuel oil and naphthas to the Asian markets, to the Middle East, to the Asian markets, there was some delay in getting those products to markets, and some ship owners decided to send cargoes around Africa, resulting in longer shipping times. But I think that for the time being, that didn't really result in any supply disruption. So which is why we saw a limited impact on prices. If the blockage would have lasted longer, it would have been more complicated. Because it would have tied up the tankers for longer. It takes roughly 2 weeks longer to sail around the Cape of Good Hope of Africa. So it would have tied up the tankers for longer. They would have had to use more fuels. It would have increased the cost of shipping. But I think the disruptions were maybe bigger in terms for other industry than for oil, actually. You know, in container traffic, goods being delivered from China into Europe, supplies that needed for manufacturing that were held up. And especially for industry that don't have the sort of the storage, the strategic reserves that we have in the oil industry. But I think that the point we wanted to make that, you know, it's why even in a weak market, when demand is weak and refining activity is weak, it's important to hold sort of strategic reserves, because you have these sort of events that you cannot predict. Here, Suez Canal was blacked from a technical glitch. I don't know. There was no sabotage, there was no attack, there was no war or disruptions as we've seen in the past. But still, it creates very significant disruptions to the supply chain. And I think, I mean, the biggest import of products that we get into on the Suez Canal coming westwards is for jet kerosene and diesel. But because both those markets are very weak now and inventories are high, it's why it didn't have a very significant impact. And the second part of this question, I can read it.
This is about the price. I think so.
It's about OPEC decision as well, related to the prices and the Suez Canal
there's a question about the decision of OPEC of increasing the production gradually.
Yeah.
What do you think about?
Yes, I think that I wouldn't say, I mean, we try not to guess what they're thinking and what OPEC, what informs their decision making, and second guess what informs their decision making. But I think, I mean, I don't really, on a personal level, I don't think that this is really what impacted this decision to increase production. The economy is recovering. I mean, we're seeing clear evidence of the economy recovering. IMF just came out with a new GDP forecast at the start of this year, and we're expecting a very strong rebound in economic activity, and oil demand will recover. We're seeing lockdowns. The COVID situation is coming more or less under control in some countries where vaccines are advancing quite quickly, such as the US and the UK. We're also getting better in Europe, although these new COVID cases and the new lockdowns in France and other countries are creating an offset. So I think that already seasonally, oil demand is increasing from the start of the year until summer, as there will be more driving, as restrictions will ease, as vaccine progress will advance further. There was a need for OPEC production to increase. Our numbers show that oil demand actually is set to grow much stronger than what the increase that OPEC has penciled in. So if they only stick with this, with the latest increase from May, June, and July of about 2 million barrels a day, we're still expecting oil stocks to continue to fall. So there's room for OPEC Plus to increase production more. And in the second half of the year, they might have to increase quite significantly higher to prevent oil inventories from declining much more sharply. Of course, is Russia afraid of US production ramping up? It's always a delicate balance for the producing countries. As we've seen, too high oil prices stimulate increased activity in the US. So if prices are too high, US production could very well increase quite sharply, and that would take away market share. So I think it's a balance for the OPEC Plus producers that they're trying to see. There's a lot of uncertainty on demand. On the one hand, they don't want to increase production too fast to risk the market collapsing again, or they don't want to increase too little to have then the US producers coming back to fill that gap. And that's why they're meeting on a monthly basis, which makes it trickier for us who look at the market. But they're meeting on a monthly basis to set the production levels, to try to, as they see demand recovery and how the other supplies are evolving. Russia has publicly said there's room for everybody. There's room for OPEC Plus producers and US producers to increase production. So it will be a balance. I see that there's...
Yes, there is, if you want, I can help you with the question, Toril. There is also a question you have seen in the chat about the impact of the US recovery plan on crude oil demand. What is your opinion about that?
Yes, no, so that's obviously something that we're looking at quite closely right now, and we're seeing more details of the stimulus plan being presented. It's not all clear how it will be approved and where the spending will be directed. But what is clear is that the US administrations are really stepping up their efforts to reduce carbon emission. And they want to put an emphasis on having the stimulus package being a green stimulus package. So they're going to spend a lot of the money on increasing infrastructure, as you say, but also to increase electric vehicle sales, to reducing emissions, to reducing energy demand. So that's on the one hand. Of course, infrastructure, we're looking at all the roads that are going to be built, so bitumen supplies, but a lot of the proposals, a lot of the details in the plans still has to be worked out. So that's something we're looking at. But besides that fact, it's clear that this enormous stimulus package is going to support US GDP, so economic activity, and it will stimulate oil demand in the United States and elsewhere. You increase spending in the United States, it has implications all the way to China in terms of manufacturing and demand for goods and services and other products. So this is something we have factored in. It's one of the reasons why we're expecting such strong growth in oil demand in the second half of the year, as stimulus packages and the easing of restrictions on mobility due to the COVID crisis.
There is another question that came in. It's about, they would like to know your opinion about the heavy oil crude supply in the near future.
Okay, yeah, so as you saw, we are expecting a lot of the growth in the next 5 years to come from the Middle East, right? There's less growth projected in the United States, which is relatively light oil. But a lot of the growth will come from the Middle East as they return capacity production that was shut in. So there will be more in terms of increase. There will be more, a bigger share of heavier oil coming to the market. In terms of Canada, we're seeing a lot of the projects in Canada being scaled back due to the COVID crisis, due to spending cuts, due to infrastructure uncertainties. Biden administration canceled the Keystone XL pipeline, and there are very few new projects coming online in Canada. But Canadian production will still grow as they recover from years of not being able to market that crude. So there's quite a bit of heavy Canadian oil supplies also coming to market. Most of it would obviously go to the United States, but some would also come through international markets. Venezuela is a wild card again. We're not expecting, Venezuelan production is currently about 800,000 barrels a day, I think, and we're not expecting a strong recovery in Venezuela given the current political situation. We just don't see how companies can continue to invest there. In most of the major oil companies that were involved in Venezuela, they just wrote off all their assets last year in Venezuela, and I think it would. So we're not very hopeful there. Iran is obviously the big wild card, as I mentioned before. Iran could increase production by about 1.7 million barrels a day relatively quickly if sanctions were lifted, and most of this oil is relatively heavy. So that would have a big impact on the market, but it's difficult to see and guess when exactly that will happen and how the Biden administration and Iran will come to terms with the other countries taking part in the nuclear agreement and how they will agree. So so I hope that answered the question.
Thank you, Toril. Arcadio, there is I think 5 minutes left, and I have some other questions that I got directly to my private chat. If you want, I can go through them very quickly.
Sure.
Yeah. There is some about refining, and if you could tell us a bit more about the impact of the new international marine organization rule in the refinery sector. And there is also interest on the current situation of the oil inventories in the European refineries and how this can affect the prices. Yeah.
Okay. So in terms of the marine sector, we already saw the biggest change to the marine sector came in the switch from 2019 to 2020. And we saw a very large switch out of high sulfur fuel oil. We were expecting a bigger increase in use of marine gas oil, actually, in terms of fuel for the marine sector. But we're seeing that a lot of the tankers have taken up this very low sulfur fuel oil or ultra low sulfur fuel oil that is a blend. A lot of gas oil pool goes into these sort of hybrid cleaner fuels. We're expecting relatively strong demand for bunker fuels in coming years. Global trade activity is still relatively strong. We're seeing a lot of container traffic and trade going from China to the US. Of course, with so overall demand is relatively strong. We're seeing now that the incentive to put scrubbers on ship is economically not necessarily so advantageous. So we're seeing, you know, the low sulfur fuel oils taking up the bigger part of the market. So this is really the only part for the refiners. There are blender companies or bunker fuel companies that do this, but increasingly also at the refinery site themselves. So this is really one of the areas where there's quite a good opportunity for refiners to take a bigger part and capture some of that margins themselves. On the second question was about refinery stocks.
Yes, and the how can
Inventories.
they affect the prices?
Yeah, no, so we're seeing, so we're tracking this very closely. We have relatively good data for oil inventories in Europe, in all our OECD or IEA member countries. But we're also trying to track increasingly what is happening outside of those countries, because now as oil demand and trade and refining activity shifts to Asia, where we don't have this data, it's becoming more difficult to evaluate the overall situation on the market. But that said, we're seeing that the oil inventories in Europe and for all of the OECD, last year we had a huge surplus that built up, especially in the first half of the year. And since about August, we're seeing that those inventories have been coming down for crude and for products. This is continuing into 2021, the first months of the year. We're seeing that there have been continued stock declines. And this is what has supported the prices really at the current levels. This and the concern that the stock draws will be bigger in the second half of the year. If OPEC Plus doesn't increase production, inventories will fall at an even faster rate. And this is what has provided support to the market. But at the same time, inventories are still looking pretty comfortable. We're still above the levels that we were prior to the COVID collapse in demand. So for us, we're not seeing it as a really big concern right now in terms of product distillates, gasoline, crude oil. All the major products are looking relatively healthy still, even though they're coming down. So, but as I said, if OPEC production stays constrained, crude oil inventories will continue to fall. If refineries pick up their run rates, assuming that demand in Europe does pick up, I mean, we're seeing quite divergent picture in different countries. But if we look at what happened last year, looking at oil demand, gasoline demand in Europe, for instance, we saw a huge collapse in the first half of the year. But during the summer, once the restrictions were eased, oil demand, gasoline demand went right back up again, right? Oh, then we had a second wave and oil demand receded and is still relatively low. But we're thinking that the refineries would increase activity after the maintenance that is taking place now in April and May, and really prepare for the summer demand. So assuming that we're out of lockdowns, that we can go on the roads again, that we can start going back to work or go on vacation, which we all hope would be a possibility. We're seeing that, but inventories, of course, it's very important. But inventories and the spare capacity that is in OPEC to sort of fill the gap. But yeah, so it's been the supporting factors. Does
that okay?
No.
Yeah, thank you. Arcadio, do you want to add something, or there is, if you want, there is some other question
Maybe
that just came?
you can give her once more, or no?
One more? Are you okay with one more, Toril? Yes?
Okay.
Yes.
5 minutes. 5 minutes to
1
go.
minute
Okay?
for one question. Yeah, yeah. There's someone who say that we are seeing a very big compromise of the European oil companies towards a net zero emission future in Europe. And is this the general trend all over the world?
This is an interesting question.
Yeah, it maybe requires more than 5 minutes. No, I'll be quick. No, we're seeing that it is a general trend. I mean, we are now, I don't know if you saw, we hosted a summit just last week at the IEA,
Last week.
and we're preparing a very important report on net zero targets and a roadmap on what it will need to meet those targets. And there's clear global ambitions. There's a push, not just in Europe. Europe has always been the leaders in terms of climate policy, but now we're seeing with the US joining, with China joining, India joining, it's really a global effort, right? So, and we're seeing it in terms of the companies as well. It was BP that was, it's the European oil majors that were leading the charge, if you want, in terms of setting net zero emission targets for their own operations, with BP and Shell and Equinor. I'm not going to talk about the Spanish companies here. I might say something, but we're seeing Repsol and others setting targets, and with less focus for in the US, for instance. It has not been, the US companies have not made the same commitments, but we're seeing the trend changing. Even the US companies, even the independent oil producers are really stepping up, not necessarily because their government has been demanding it, but because investors are demanding it, because the public is demanding it. So the environment and sustainability targets, it's really becoming something that is impacting all companies. We're seeing Chinese companies announcing, Chinese oil majors announcing targets. Of course, there's a big divergence. You know, Europe is still at the forefront. We're seeing companies elsewhere, but you know, some of the Middle Eastern producers, they have different strategies in terms of circular economy, or in terms of carbon capture and storage priorities, or hydrogen. Even in Russia, that has so far not made any significant commitments, we're seeing those companies coming out with statements and pledges now. So it's not just a European phenomenon. Europe has been leading because of the political environment that maybe has been the key driver. But other companies around the world are also stepping up their efforts. So this is encouraging, and it will, you know, hopefully leave a level playing field, if you mean. What we don't want is that some regions and companies are making the reductions only to let it be displaced by somebody else, which sort of defeats the purpose. It has to be a global effort for the overall targets to be met.
Thank you very
Hey,
much.
Tori, you have explained in 5 minutes very well this situation. I hope you are going to present here this report. You are putting out on 15th of May, I think I heard, no, about this strategic about net zero.
18th of May, I think.
18th of May. We will wait here for you or whatever for the EIA for presenting this new report. No?
Yeah.
Thank you very much, Toril. It was a pleasure as always of having you here. I think, as I said, congratulations for your appointment as the head of this oil. You knew very well all this, and you know very well all this field, and this is a pleasure of having you here once again next year or whatever, or maybe on May or June. Thank you very much, all of you, and stay safe.
Thank
Sorry.
you very much. Always a pleasure.
A pleasure as always. Buenas tardes o buenos días a todos y esperemos que haya sido una presentación. Podéis descargarlo en esta dirección. Es la primera. This is the first time that this report is free for downloading, and this is a good policy for IIA for the future. Okay, we are going to recommend your general director to do that always. Okay. Thank you very much, Toril. Buenos días a todos.